Okay, here we are again. So let's get cracking. Okay, so I'm pretty sure I sent you, well, let me make sure. Let me hold on 1 second. Hmm. I just want to confirm what I've sent you so far. Well, that's very bizarre. I really thought I'd sent you a bunch of materials with that last invitation. And now, of course, I can't find it. Oh, here it is. All right, here we go. So yeah, I just want to confirm what I've sent you. So this was left over from last week, the week 3 notes session, the week 3 PowerPoint with the handwritten notes. And there's a 4th assignment, there's a template, and there's also the options notes. Okay, that's fine. So these are the options notes. There's a template, which will come in mighty handy, as you'll see. And actually, this template is more about strategies than anything else. I think that's all that we cover here is strategies. And then we also have, oh, the assignment is right here. This involves strategies. Oh, I see. Okay. No, that's all you had to do. All right. So that's good. So we're looking more at options this week, features of options markets, where we'll be covering the basic properties of options. We're going to calculate the payoff of an option. We're going to calculate the profit or loss of an option. And we'll be looking at some basic option strategies. All right, so now some of this we've already covered, but not to this depth. And also the focus now is more on the strategies that we can employ, whether they're for hedging purposes or for speculation. There's a lot of different positions we can create with options that would be impossible with any other types of securities in the marketplace. So this is where options really pay for themselves. So first things first, of course, we already know that an option is a derivative security that gives the owner the right, but not the obligation, to buy or sell an asset in the future at a price agreed on today. So the characteristics of an option include what is the underlying asset? In other words, what is it that we have the right to buy or sell? And of course, there's so many to choose from. You name it, there's an option out there that can be written on that asset. Or in some cases, these are not even assets. For example, equity indexes are not assets. They're just numerical values that represent the overall performance of the stock market. Interest rates as well, those are not actually assets, but they are, of course, an important financial variable. And so you can buy options whose value depends on interest rates, currencies, equities, equity indexes, precious metals. And of course, they can also be bought on futures contracts. And if that happens, they're referred to as futures options. And in fact, futures options are very convenient. They're more complicated, but they're very convenient because when you have an option on a futures contract, what you're actually buying the right to do is enter into a futures contract on some underlying security or asset. So for example, you could buy a futures option on the British pound. And if you do that, what the option is giving you the right to do is not buy the pounds, it's giving you the right to enter into a futures contract written on the British pound. And from there, once you exercise this option, you will then take possession of a futures contract, which you then can use as you see fit. You can use it to actually take possession of the British pounds. You can close it out prior to the maturity date. You can do whatever you want, but the option itself isn't giving you directly the right to buy the British pound or to sell them. It's instead giving you the right to take a futures position on the pound. Now, the reason why that's very popular is because it means that you never actually have to take delivery or make delivery if you don't want to. If you buy an option on the British pound, directly on the British pound, then it's understood that you're prepared to either take delivery of the pounds or make delivery if you're buying the put. Whereas with a futures contract, you never have to worry about that. So an option on a futures or a futures option at this point in time actually accounts for the majority of options trading in the marketplace because of that extra flexibility, which means you never have to worry about either delivering the underlying security or else taking delivery of it. There's some cases though where, like for example, interest rate options are still written directly on the underlying asset because first of all, for these interest rates, there may not be a futures contract in the first place. And secondly, when we're hedging interest rates, typically we're really only interested in hedging our risk at a specific point in time. So having a futures contract doesn't really bring us any advantages. So those types of options typically are still written directly on the underlying security, like interest rates or individual equities for that matter. If I wanted to buy, for example, an option on Apple stock, there is no such thing as a futures contract on Apple. So therefore, the option will be written directly on the Apple stock. But again, the majority of the options that trade in the marketplace today are actually futures options. Again, it's because of that extra convenience where we do not have to worry about taking delivery of the asset. Now, the strike or exercise price simply tells us the price at which we can buy or sell the underlying asset. The maturity is the time until the option expires. So if your option expires, let's say on December 1st, you have to make a decision by that date whether or not to actually exercise the option. If not, the next day your option expires worthless, even if it had a value. If you don't exercise it when it has a value, you just lose the value. So in other words, it's up to you to know when it makes sense to exercise it or not. Now, we also saw that a call is the option that gives you the right to buy something, and a put is the type of option that gives you the right to sell something. So I don't know where these names actually come from, but remember, call is the right to buy, put is the right to sell. And in addition, we have European options, which only can be exercised on the expiration date, and the American style options, which can be exercised anytime we please, up until and including the expiration date, after which both styles will expire worthless if we do not either exercise them or possibly sell them to somebody else. Now, of course, that makes the American option more valuable than the European option, but it also means it's going to be more expensive because, of course, as you know, unlike other derivatives with options, we actually have to pay for them. All right, and the amount that we pay for them requires a lot of complex modeling to figure this out properly. And so this is where all the math really gets involved with the pricing of these options. And the premium, yes, exactly right there. The premium is the price that you have to pay to buy an option. And so unlike a forward contract where there is no premium, a futures contract has no premium. It does have a margin requirement, but not an actual premium. And the same thing with a swap. Normally when a swap is entered into, it has value of 0 to both sides. So no money changes hands. An option is completely different. No matter how well or poorly the option is performing, it always has a price, a positive price, which you must pay as the owner of the option. And of course, if you never exercise the option, you lose that premium, just like an insurance policy. If let's say you have auto insurance, if you never have an accident, well then you're just, you never get the premium back. Once you've paid it, you don't get it back, whether you actually need the insurance or not. And the same thing's happening here. You're never going to get your money back once you pay for an option, okay, whether you exercise it or not. All right. And of course, the reason why the option is so much different than the other securities, the other derivatives, that is because of this right here. You can see that with an option, you have limited loss potential, but unlimited profit potential. And that's a very nice position to be in. You don't get this with other types of securities. In fact, with some securities, it's the other way around. You can actually have securities where there's an unlimited loss potential and a limited profit potential. Here, there's only so much you can lose, and that amount is typically the amount you paid for the option. But on the upside, in principle, there is no maximum profit you could earn from an option. So that makes it a very exciting instrument for us to use for hedging purposes, but also for speculation. In other words, investors may want to buy options because they could make a lot of money in a hurry if everything goes right. And in fact, options, as we'll see later on tonight, are very heavily leveraged, in the sense that it only takes a small change in the value of the underlying asset to generate a huge profit for the option. And that's another exciting feature that people really like. Okay, so we're going to explore this in more depth as we go along here. So here's the payoff function. Now, what exactly is going on here? Well, what this means is that S is the spot price of the underlying asset and X is the strike price of the option. Now, max, of course, means maximum. So this is a very compact way of saying that the payoff is S minus X if this is a positive number or 0. So in other words, if S is less than X, instead of having a negative payoff, we simply choose not to exercise the option. Ooh, sorry about that. Yeah, so in other words, if we've discovered that S is less than X, it would make no sense whatsoever to buy this or exercise this option. Instead, we'll simply let the option expire worthless, and so we will then be said to have a payoff of 0. So in other words, it's not possible to have a negative payoff with a call option, which is kind of a nice feature. So let me show you a quick example of that right now. Imagine the following situation. Okay, let's say that an investor buys a call on Apple stock with an exercise price of 100. The maturity date is September 1st. Okay, so on September 1st, or let's assume the stock sells for 140. Now, you have in your hands the right to buy a share of Apple stock with your option for $100, but it's worth 140. That's good. That's good news for the investor who owns this call option, because I'll leave it there for a second so you can catch up. But you can see why this is so helpful, because you have a security in your hands which says you have the right to buy the stock for $100. but in the market, the stock is worth $140. So here's what you can do to make an instant profit. What you can do is, or the investor will do, the investor will exercise the call option by paying $100 for a share of Apple stock. The investor can then, if he chooses to do so, immediately sell the share of stock for $100, $40. The payoff is therefore $40, which you can write this as S minus X, where S is 140 and X is 100. All right, now what if this didn't happen? Suppose that instead that the stock price on September 1st was $90. Since the call option's strike price is 100, it makes no sense to exercise the call and pay $100 for a stock that is only worth 90. The option will therefore expire or be allowed to expire. The payoff will be zero. Okay, so in this case, there's no point in exercising the option. Why would you pay $100 for something that's only worth 90? So in this case, the payoff is zero. So if you notice, in the two scenarios, when S was equal to 140, the payoff was 140 minus 100 was 40. And you'll also notice that S minus X is positive. On the other hand, when S equals 90, the payoff is just zero. And so S in this case minus X is negative. Okay. So that's why we have this max thing. So now hopefully this makes a little bit more sense. Yeah, so you can see this is basically a way of consolidating all this information. So max S minus X or zero means that it's the greater of S minus X or zero, which means S, just in general, let me move this to the next slide. Which is the same thing as saying the payoff is S minus X as long as S is greater than X. The payoff is zero if S is less than or equal to X. Okay, so that's really all that it's saying. And so here, I'll put in parentheses, the option is not exercised. Here, the option is exercised. Okay. All right, so that's that one. So that's what the payoff is all about. Now, if you wanted to draw up a little chart, oh, by the way, I just want to throw this in here. In the options markets, there's terminology that's used for these situations. When, with a call option, S is greater than X, and exercising the option would provide us with a positive payoff. In Wall Street, they say that the option is in the money. And that simply means that if we exercised it right now, we would have a positive payoff. It's basically horse racing terminology, but somehow Wall Street got a hold of it. And now this is what they say down there. And so in the case that the spot price is exactly equal to the strike price, then the payoff would be zero. And we call that at the money. It's sitting right on the fence between having a positive payoff and none. And then when S is below X, then we would not ever exercise the option. We say that the option is out of the money. All right. Now, here's an example, and we're going to use this information to actually derive a graph that shows us the relationship between an option's payoff and the underlying asset price. And we're going to find out pretty quickly that these graphs are extremely helpful in helping us understand visually what relationship there is and how it compares to other options. It also will help us derive strategies that we can use to either make money or else hedge our risks if everything turns out right. So here, for example, imagine that there's a European call on IBM stock that expires on September 1st. The strike is $50 and the premium is $3. We pay that to buy this option, and we do not get to keep that. We don't get it back, even if we do not exercise the option. Well, so what I've done is I put together a table of possible stock prices on September 1st. And of course, the strike is 50 throughout. So now, and of course, we don't know which one of these will actually happen, but let's just say this is the range of possibilities that we think is likely to happen. And over here on the right, we've calculated the payoff. Now, the first thing to notice is that as long as S is not above 50, we're going to have a zero payoff. Okay, and that's because we would not exercise the option under any of these conditions. Once we get past that point, once S gets above X, every, in this case, $5 increase in the stock price adds $5 to our payoff. So here, for example, the payoff is the difference between these two numbers, which is 5, and that jumps up to 10, 15, 20, 25, et cetera, et cetera. So you can see from this graph, there's an important pattern that's emerging. And when we graph it, you'll say, oh yeah, that looks right. That makes sense. So if you put this together into a nice little plot where the payoff is on the vertical axis and the spot price of the asset, or in this case, the stock price is on the horizontal axis, you'll see that it has a very interesting shape. In fact, you can see what's happening down here. The strike price is 50. So here's where the call option is at the money. Once you get past that point, the option is in the money. And then down here, we're out of the money. And so if you notice, it's essentially two regions to this curve. This part is flat. It has a slope of 0. And over here, this part has a slope of 1, which means that every time the stock price goes up by $1, the payoff goes up by $1. And that's what it looks like. And on the upside, you notice this can go up forever. There's absolutely no upside limit to how much this payoff can be. But on the downside, the payoff can't go below 0. So that's one of the big attractions of options. All this upside potential combined to a limit to how much we could lose on the downside. That's very attractive to a lot of investors. All right, now, the next thing we have to take into account, though, is which we've kind of been neglecting up to this point, is what about the premium of the option? How does that affect our results? Well, now what we need to do is make a distinction between the payoff to the option and the actual profit or loss. So the profit, in a nutshell, the profit or possibly loss equals the payoff minus the premium. So what this means then is that the profit or loss can be negative, whereas the payoff cannot be negative. But the loss is limited to the option premium. Okay, just like insurance, you keep paying that insurance policy and you never use it. You can, in effect, say that you're losing that much money, but you never know when it might come in handy. So here, the absolute worst case scenario is that you lose the premium that you paid for this option. That's as bad as it can get. But there's no maximum profit in this case. Now, as far as the graph goes,
Professor,
yes, go ahead.
a question. So in this example that you gave us, we would be losing just the premium would be $3.
That's correct. If you did not
Okay.
exercise the option, you cannot lose more than $3.
$3. Perfect. Thank you so much.
You're welcome. And in fact, that'll show up on the next slide, the next graph that comes up, because here I'm repeating again this formula. And so when you'll see in a minute on the graph for IBM stock that since we paid $3, the limit to our losses is in fact $3. So let's look at another chart that I put together. And this time I've added 2 new columns. I've got the call premium right here. And if you notice in the last column, the profit is simply the payoff, the payoff minus this $3. So all of these numbers are just the payoffs minus $3. And now all of a sudden there are some losses. This is the maximum loss. Okay, but again, there's no maximum profit, which is what we like so much about options. Okay, and then now the graph, as you can probably imagine, the shape of the graph won't change because we're only shifting it, or it's only being affected by a constant. The slopes won't be affected. So what's going to happen is we'll shift the whole thing down by $3 in this case. And you'll see the basic shape is exactly the same. Okay. All right, let's take a look at this thing. Oh yeah, what do you know? It looks exactly like the last one, except for 2 differences. Number one, we do have a limited loss right here. This whole region. This represents a loss of $3. Think of the shaded region as our maximum loss. But now on the upside, here is $53, which equals the strike price plus the call price. This is the so-called break-even price of the stock. Or we can think of it as a break-even point. So in other words, in order for you to have a profit of 0, the stock price has to be at least 53, where you would have a $3 payoff, but you also need to cover the $3 premium. Anything after that goes right into your pocket. Okay, so that's, yes, you can see there's a lot of upside potential there. All right, now that we've analyzed the calls, let's look at the puts. The put is the opposite in the sense that we have the right to sell and we hope that the price goes down. We benefit from a falling stock price. With a call, we benefit from a rising price. With a put, it's the other way around. We hope that the price will go down. So the payoff function will reflect that. In fact, I'm going to show it to you now, and you'll say, hey, that looks kind of familiar. Well, the difference between the two is that the call payoff was max x minus s and 0. Oh, sorry, no, it's not my fault. I'm looking at that one. It's no, s minus x. And down here, suddenly it's x minus s. So down here, the payoff is positive if the stock price is less than the strike price. So in other words, we're hoping that it goes down. And we don't want it to go up, that's for sure, because the payoff is 0 if S is at least as great as X. So when you buy a put, you're basically gambling on the price of the stock going down. You're taking a pessimistic view on the stock, which is perfectly possible. Any stock in the economy can go down. If you think that a company is losing money or something's going wrong, you can put money on your bet by buying a put option. And if you're right, you'll make plenty of money. And in fact, this is an interesting situation because it's really not that common to find securities that will let you bet against a price. In other words, without options, how would you bet on a stock price going down? Well, it would be awkward and difficult. Not impossible, but it would be difficult. But here, it's a simple matter of just buying a put. It couldn't be any easier. All right, so let's take a look at how the graph would look. And and by the way, of course, if that's our payoff function, the profit or loss function would be this. So as always, it's the payoff minus the put premium. So again, the maximum loss equals P. So that's as bad as it can get. Now, the terminology here has to work a little differently. So I put together another chart for the moneyness it's called. And so this time, you'll see that if the stock price is lower than the strike, we're in the money. When they're equal to each other, we're at the money. That's the same as what we had before. And now, if the stock price rises above the strike price, we're actually out of the money because remember, put is the one that benefits from a falling stock price. All right, so that's that. Okay, so now we'll look at another example, except this time it'll be a put. It's still IBM stock. And what we want to do is look at the graph. First for the payoff, then for the profit and loss. And well, if you're good at geometry, you'll be able to figure out what it looks like. If not, well, you'll see. It'll make sense once you see it. So suppose that an American put on IBM stock expires again on September 1st. The strike price is 50. This time the premium is only $2. So let me make a note here, and we'll get to this later on. In general, calls are more expensive than puts. Assuming that they're identical. In other words, they have to have the same underlying asset, they have to have the same strike, et cetera, et cetera. But just in general, calls tend to be more expensive than puts. Not always, but most of the time. All right, well now, once again, we'll have a payoff diagram, except, well, first, let's look at the table. And you'll see the payoffs are calculated, and you'll see that this time, as long as the stock price is at or above the strike, we have a payoff of 0. All right, this would be out of the money. And this would be considered at the money. And up here, these would be considered in the money because they have a positive payoff.
Professor, so with puts, we have a limit on how much profit we can make.
That's true. And the only reason for that, though, is because we can't have a negative stock price. But that's a very good observation. But it's limited, but it's a very high limit. Okay, so technically, we no longer have an unlimited upside potential, but we have a very high upside potential because the maximum payoff occurs when the stock price is 0. In fact, if you look at the graph, although it doesn't go all the way down, it will have to stop. Let's say if this is 0, then it would have to stop on the vertical axis. It can't go down any further. But you can see the upward potential is still quite high. Okay, so here's the strike. Again, here we are in the money. And out here, this is at the money. And then down here, we're out of the money. So actually, sometimes on Wall Street, they refer to the options position as its moneyness. They've created a completely new adjective, completely out of thin air. It refers to the degree to which the option is in, at, or out of the money. And of course, now what comes next is we're going to show the profits and losses where we have to take into account the $2 that we paid for this option. So we're basically shifting this down by $2. But again, because that's a constant amount, the slopes won't change. Okay, and oh, and by the way, the slope down here is 0. And up here, the slope is actually -1. So in other words, as the stock price falls by $1, the put price, or I should say the payoff, rises by $1. So it's a 1-to-1 relationship. They're going in opposite directions. So the slope is therefore -1 instead of +1. All right. And then, so I'll do exactly what I said. We're going to show the profit and loss diagram here, where we just basically shift everything down by $2. So I put together another chart, just like the last one, and I've got 2 extra columns, one with a put price of 2 and one with the profits, where I simply subtract $2 from all of these payoffs. And of course, you can see here's our maximum loss. And it's not a coincidence it equals this number, the put price. After that, it's all positive.
Yeah, Professor, actually, it was just a question, if you don't mind.
Yes, go ahead.
So why would anyone exercise a put option? Because they can just directly go to the market and buy the same stock,
but you
right?
see, they want to sell it. That's why.
Okay.
I
But
mean,
on
sure.
the other side, someone who is like on a call, they can go to the market and buy it, right? Rather than buying it, they can just not exercise the call option of who is on the opposite side of the put.
Oh, well, I mean, we're going to get to this in a minute, but for every buyer, there has to be a seller. So if I'm buying a put, somebody has to be selling it to me, and their payoffs will be the exact opposite of mine. Is that what you're referring to?
Yeah, it's just if I was thinking the same thing actually. If I'm in a put option, I have to find a call guy, right? I mean, if that
No, no, no.
person.
No, it's not a call guy. If you're buying a put, you find a put seller.
Okay.
So now we're going to show in a few minutes what their payoffs look like. The bottom line, though, is that the seller is the one who collects the premium. So if I'm buying this put from, let's say, Goldman Sachs, in the over-the-counter market, that means I'm paying $2. They get to keep the $2, and they hope that I never exercise it. In a way, they're acting like an insurance company, because you know how it works with insurance. Everybody pays in their premiums, and the insurance company will make an awful lot of money if nobody ever has an accident. But if they do, then they may end up being stuck with a huge payoff to the policyholder. Now, if you're like a Goldman Sachs and you're dealing in options, if somebody buys a put from you, you find yourself exposed to a lot of risk. Most likely you'll take other offsetting positions to reduce or eliminate the risk that you encounter from that transaction. So they're not just going to sit there and say, oh, we hope that nothing goes wrong. They will find strategies to help them offset this risk to a certain degree and still make money in the process. That's what they're hoping for. But yeah, if you just sell an option to somebody, you're putting yourself in a terribly risky position, because if the buyer has unlimited upside potential, that means you have unlimited downside potential. So a position that risky would always be offset with other positions to take away most or all of the risk. So because they know what they're doing, the option dealers know what they're doing. But as an individual, you could end up making a terrible mistake like that. So in fact, from what I've been told, if you're trying to buy options with a broker, they start out by finding out if you have enough money to afford losing from these trades. And then if you do, then they want to know how much sophistication you have. And if they don't think that you're ready for this, they'll turn you down. They'll say, listen, no, don't come here, because we don't want you losing all your money. And so it's not as simple as it sounds to deal in options. You'll probably need a certain minimum amount of money, and they'll probably try to discourage you if they don't think you have enough knowledge of the market to make any trades. Because again, they're worried that you might lose an awful lot of money in a hurry without realizing what's happening.
That makes sense. Thank you.
Yes. Now, even later on than that, we'll see that sometimes the same trader will buy and sell an option. And the purpose of that is to create different kinds of payoff profiles that you could not get otherwise. So let's say I might buy a put with a strike of 50 and then turn around and sell a put with a strike of 45. And you might say, well, why did I do that? Well, we're going to find out why that you might do that, because you basically have a view on where the stock is heading, and you're trying to take advantage of that. You're trying to basically place a bet that will give you a lot of money if you're right. Okay, so it's kind of like, have you ever been to a casino and played the game roulette? Do you know how that works? It's like a big wheel with numbers on it, and you bet on it. Well, the thing about roulette is it's not like an all or nothing game. You can bet on different types of situations. For example, there are 36 numbers on the wheel, numbered 1 through 36. You can bet on any individual number, on ranges of numbers. You can bet on odds. You can bet on evens. You can bet on red. You can bet on black. So the options, in a way, are like that. They give you the opportunity to bet on certain specific outcomes. And if you're right, you can make a lot of money. So here you're allowed to basically customize your exposure if you know how to combine these options properly. So while just selling a single option might be horribly risky, combining that with other options positions might put you in a position that you want to be in to take advantage of your outlook on the market direction. All right, anyway, so all of this stuff will be coming up very soon. So yes, as I started to say, now the put, remember, was only $2. So losses are limited to $2, which will occur if the stock price is anything from 50 or above. We'll call that our maximum loss. And here's a break-even price. it's actually $48, which equals X minus the put price. And then from that point on, each, as we've seen, a $1 reduction in the stock price adds $1 to our payoff. Okay, and so, but again, yes, there's a limit. So the maximum profit then, although you can't actually see it here, would be X minus P. So in other words, in this case, $48, because this will happen if P goes to zero. If the stock goes to zero. So the stock price goes to zero, we'll have an X dollar payoff, but we have to pay for the put. So in this case, that would leave us with a $48 profit. It cannot go any higher than that because X can never be negative. The other thing I wanted you to notice is in terms of just geometry, what do we see here? If you draw these together side by side, you'll notice something very interesting. Here's the call, profit or loss. Now, these graphs are not as good as they could be, but, and then the put, profit or loss. Yeah, well, okay, you get the idea. That's why we'll be using Excel later on. So in other words, they're mirror images of each other from left to right. Okay, so in other words, you can actually imagine that there's a mirror here separating the two. And so from left to right, they are the same. Okay, so that's kind of important. All right, now, as we started to discuss, what about the sellers? For there to be a buyer, there has to be a seller. Now, keep in mind too, that with options, we can buy them through the over-the-counter market, which means directly from a counterparty, like a commercial or investment bank, like Goldman Sachs. They have a whole division there, which just does derivatives. And if I'm a big corporation and I need an option on some stock or other, or an option on anything really, I just call them up and say, listen, how much would it cost me to buy an option on this, this, or that? And they'll quote a price. So these options can be customized for anything we want. Like, let's say I do business in a small country, like, let's say, what would be a little country that I might, Iceland. Okay, let's say I do a lot of business in Iceland for some reason, and I would like to buy an option on the Icelandic krona, as it's called. Well, I'm not going to find that on an exchange, that's for sure. It's too obscure a currency, but I can arrange it with, let's say, Goldman Sachs, because that's the business they're in. And when you come right down to it, I mean, when you're negotiating like this, all you're really doing is creating a contract between the buyer and the seller. So I'm saying to Goldman Sachs in my call, I want to have the right to buy Icelandic krona for, let's say, 50 cents US. And they will say, okay, for that, we'll charge you X dollars. All right. Now, by the way, this is one thing I've kind of glossed over up to this point. Just to keep it simple, But typically in the United States, options written on stocks typically do not give you the right to buy a single share, but 100 shares, which is the normal amount. So that means that the amount you're actually paying is 100 times the quoted price. So for the IBM put, in practice, this would have probably been written on 100 shares of IBM, which means the premium is really $200. And so that's going to be true for just about every option. What separates one from another is how many units of the underlying asset you're buying. So anyway, so the seller, so I enter into that contract with Goldman Sachs. They're now selling me a call option on the Icelandic krona. So any money I make has to come out of their pockets. And if the option was acquired through an exchange, it's the same thing. The only difference is that I never know who the counterparty is. If I buy this from the Chicago Mercantile Exchange, that means they will match me up with the seller. And I never see the other side of that position. I have no idea who's on the other side. I just know that I bought this option on the Chicago Mercantile Exchange, and I know that behind the scenes, they've hooked me up with a seller. So once again, my profits are his loss and vice versa. But now keep in mind, the sellers, although they're in a very risky position, they also are the ones who collect the premium. So again, it's really, in that sense, just like an insurance company. I mean, when you think about it, I mean, I'm buying insurance on my car, let's say. I'm paying, let's say, $100 a month. And suppose that my car is worth $20,000. For $100 a month, if I crash that car, they might have to pay me $20,000. That seems like a terrible position to be in. Why is it that they can afford to survive when I'm paying them so little money compared to the value of my car? What is the reason why this is possible? Because what is the likelihood that that will actually happen? It's low. It's really, really low. And also they have a lot of clients, policyholders, I should say. So at any given time, if they're managing everything correctly, they should have more premiums coming in than policy payments going out. And then on top of that, if they're really smart, they're investing the premiums so that, while we're waiting for something to go wrong, we can at least earn some interest. And so insurance companies are major buyers of corporate bonds and treasury bonds because they're relatively safe, but they do provide a rate of return so that they can make sure that they have enough money to cover any losses. So yes, again, there's that insurance analogy. But even insurance companies can run into trouble. Now, here's an interesting side note. Suppose an insurance company realizes they've got too much risk in their books. They can't cancel people's accounts just because of that. So what they do is they can sell some of their policies to what's called a reinsurance company. They do exist. You may have heard of them. Swiss Re, for example, is a reinsurance company. And what they'll do is they'll buy up policies from insurance companies that are afraid that they're overexposed to certain types of risk. And so they'll do that for a fee, of course. And then they will take responsibility for hedging the risks or finding somebody else who wants to buy them. So anyway, so the writer, being in the opposite position from the buyer, has limited potential gains and unlimited potential losses. And they do get to collect a premium, but this wouldn't work well, except for one thing. It turns out that studies have shown that the majority of options finish out of the money, which means they're never exercised. And so that's why it's possible to have sellers, because they know that even though everything's working against them, there's a very high probability that they'll never have to make a payoff to the buyer, and therefore they can just keep their premiums a large percentage of the time. All right, so what kind of payoff would they have then? Well, the buyer, remember, I'll just write these down here, but I think you remember. The only thing that's different is this little negative sign. And why is that? Because the payoffs to the two sides have to add up to 0. All right, that's the thing to keep in mind. The payoffs to the buyers and the sellers have to add up to 0. In economics, this is often called a zero-sum game. You may have heard that phrase before. It just means that the gains of one side match the losses of the other side. You can't both win and you can't both lose. Okay, so that's how that's determined. But if you look at the profits and losses now, instead of subtracting the put and the call premiums, we're adding them. So there you go. So remember, just as a quick reminder, how does this work for the buyers? All right. And so you can see the difference between the two. If you add these together, they will again add up to 0. So the profits and losses must add up to 0 because again, we have a zero-sum game. Now, the interesting question is, what does this do to the graphs? Good question. Let's see what we can do here. So we're going to go back and revisit the IBM call. Remember, the price was $3. So we'll start by calculating the payoffs. Now, of course, the payoff is basically this piece without the premium. And so if you notice, the difference between now and before is before we had all zeros here. The option was out of the money, and it still is. Here we're at the money. And then finally, here we're at the money, or in the money, sorry, in the money. But guess what? This time they're all negatives because that means this money is being paid to the buyer and we're the seller. So that means these are all simply negatives of what we had before. And you can see too, the payoff can never be positive. Ooh, that's scary. The seller of the option can never have a positive payoff. What about the profits though? Oh, and let's look at the graph, of course. Ooh, now that looks kind of familiar. And so you've got, it's flat. Here's the strike. The slope is 0. But now here the slope is -1. And of course, this part hasn't changed. So just a quick little reminder, let me draw these both for you together so you can see them. all in one place. But I think you're seeing where this is going. So before the call buyer's payoff looks like this. Actually, you know what I'm going to do to make it a little easier to see it? Why don't I switch colors? Because I have plenty of them here. Why not? And then down here, now here's where we have to be careful. In the bottom case, we're starting at 0 and working our way down to negative numbers. All right, so that's one thing we have to note here. Okay. Whoops, I wrote the wrong thing. Call seller. So here the symmetry before, remember from left to right between a call buyer and a put buyer, there was a symmetry from left to right. Here, there's a symmetry, meaning that they're mirror images of each other from top to bottom. In other words, you can imagine that if you held this graph up to a lake, the call buyer, and you looked in the water, you would see the call seller. It's just the reverse. And of course, it makes sense because the two have to add up to 0. Now, what about the premiums, though? How does that affect our graph for the seller? All right, so once again, we've got a nice little chart where I put in another column for the call price. And that's $3, remember. So the payoff, all negatives down here. We add the $3, and here we do have a range of $3 profits. Sorry, these are out of the money, yes. So when the option is out of the money, we're still making a profit. Oh, except for that last one, that's at the money. And here we have in the money. And so the profits are reversed, of course, from the buyer. So let's visualize what that graph will look like. We're shifting it up this time by the full $3. And so this is what we end up with. Okay. So break even is the same as it was before. X plus C. And then from this point on, it's all losses. And here is our maximum profit. And that's the call premium of $3. After that, it's all downhill, and it can go. Now you can see, is there any limit to how far this can go down? No, absolutely not. All right. Now, for the put, now we get to look at the seller of the put for the first time. Let's look at their graph or their chart. So here we go. Now, again, just like before, these are all the positions where the put is out of the money. Here we're at the money. And then finally up here, the option is in the money. Yes. And so you'll notice that here we also cannot have a positive payoff. Oh, that's pretty frustrating. Now you can see at the high stock prices, the payoff is 0, and then it drops off after that. So let's see what this thing looks like. Oh, okay. And here's in the money. X, of course, is at the money. All right, so what I'm going to do is what I did before, just to remind you what the long put position or the buyer's position looked like. Just again, so you can see the symmetry. See what I can do here. So once again, just we note that this is the 0 axis here. And so the put buyer is here. And here's the put seller. And of course, we have symmetry from the top to the bottom. So when the two of them are added together, we end up with 0. All right, now, of course, what we still have to consider is the profits of the put seller, which means that they're collecting the $2 put premium. And so I put in another column here and combine that with the payoff to give me the profit. And you can see, oh, look at this. So up here in the out of the money territory, I'm keeping my premium also at the money. And then down here, the options in the money, which means I'm losing. Okay, so let's see what it looks like. We shift this up by $2 compared to what we had before. And now here's X minus P. Here's our maximum profit of $2. And down here, eventually it will reach a maximum loss. Yeah, maximum loss will be X minus P. Again, because the stock price can't be negative. All right. Now, those are the four basic positions. We've got the buyer and the seller, the call and the put. So what follows is our discussion as to how we can combine these into some very interesting strategies. Now, by the way, before I forget, I wanted to send you, there it is. I think I forgot. This is the options. This is an organization called the Options Industry Council. And they're there to teach people how to use options, basically. What they've got in this document, which I forgot to send it to you, I'll take care of that tonight, is they've put together a very large number of different strategies that can be employed with these different combinations of options. And we're going to look at some of these tonight, but not all of them. And in each case, they're going to explain to you how you create these positions, what the profit or payoff looks like based on that graph, and whether it is considered to be bullish, which means we're betting on the asset price going up, or bearish, which means that we are expecting the price to go down, the risk and the reward. Implied volatility, we'll discuss that at another time. And we also want to know if the position benefits from the passage of time. And finally, they have the break-even point. So in other words, they do a nice job of analyzing all these different positions, of which we only really have time to look at a few. But I would like you to have a copy of this because there's so many in here, and some of them are just downright bizarre. Okay, so I'll save that for later when we've started to do these basic strategies, so you have something to compare them with. But I think you'll find it to be extremely interesting. So why don't we start thinking about what can we do with our options? How can we combine these to create interesting payoffs and profits and losses that would be impossible with just the underlying assets or even other types of derivatives? So the two basic styles that we'll be considering are called spreads and combinations. Okay, spreads and combinations. So what exactly does that mean? Well, we'll find out in a minute. I'll just give you a minute to catch up here. All right, so a spread simply means we have two or more options that are either all calls or all puts. In other words, we do not combine them. Either we have a collection of calls or we have a collection of puts. It turns out that whatever we can do with calls, we can do with puts and vice versa. Although the exact payoffs may be slightly different, the basic strategy is the same in both cases. So the ones we want to consider tonight are, let's see what there's, by the way, the names. Sometimes you can tell what's going on from the name. Usually you can't. The names are often not very meaningful. Somebody on Wall Street chose the name. We don't know why, and it's stuck ever since. A bull spread. Now this one, it might be the name might be somewhat helpful because the word bull indicates that we're bullish, that we are expecting the underlying asset to gain in price. A bull spread consists of the following. We're going to buy an option, and it could be a call or a put with a low strike price. And then we're going to sell an option. Again, it has to be the same. If they're either both calls or puts with a high strike price Both of them are written on the same asset and they both have the same maturity. Otherwise, we're looking at a different position. And it might not seem possible, but this will actually give us a profit if the price of the asset goes up. The only drawback is by doing it this way, we've capped our upside potential in exchange for a lower cost of setting it up. So that means you set up a bull spread rather when you are cautiously optimistic. In fact, you know what we could do? Whenever we're not sure, we can go back and look at this document and see what they have to say about it. Let's get it open again. I know this is in here. I'm going to see if I can find out what its opinion is of bull spreads. Oh, I don't know if it's possible to search a document like this. Oh, that would be very annoying. Well, that's the long call. I mean, we've seen that already. That's what it looks like. Oh, here we go. If we create our bull spread with calls, it says here that the risk is limited, but so is the reward. Okay, so this red arrow represents, and we'll see in a minute why it looks this way. If you combine the payoffs to the call that you're buying and the one that you're selling, this is what the combined position looks like. And you can see that if the stock price stays low, we could lose money, but it's limited. If it starts to go up, we can start making money, but again, unfortunately, it's limited. So the motivation for doing this is that the cost of buying one call and selling the other is cheaper than buying a call by itself, because selling a call puts money in our pockets. So what you're essentially saying is, I think the stock price will go up, but I don't think it'll go much up past this point. And if I'm right, I could save a lot of money by selling this call. I'm giving up a lot of upside potential that I don't think is going to happen in exchange for a cheaper price. If I'm right, I'll be happy. If I'm wrong, of course, I'll be unhappy. The stock price goes way up here somewhere, I'll be very unhappy. So I'm betting on the direction going up of the stock. So it's still technically a bullish position. Like it says here, bullish meaning I expect it to go up, but it's very limited. It's like I said, it's a very cautious investment. All right, but it does work. So let's see how that would work now. And by the way, when we construct this with two calls, it's known as a bull call spread. And then if we put it together with two puts, we simply call it a bull put spread. Okay, so let's set up a bull call spread from some IBM options. So before we saw this IBM call with a strike of 50 and a price of 3, it matures in September 1st. Let's assume that there's also another call option trading in the marketplace on IBM, same maturity date, except this time strike is 53. Because it's a higher strike, the call price is lower. So with a call, the higher the strike, the cheaper the option will be, because it's harder to make money that way. All right, in other words, with the 53 strike call, the stock price has to go up further to make money than with the 50 strike call. Therefore, the price will be lower. All right, so we're going to buy the lower strike call, and we're going to sell the higher strike call. So let's put it together in the following way. So we've got two calls. The first one has a price of $3 and a strike of 50. The second one has a price of 2 and a strike of 53. So the only way to really analyze this properly is to put together a chart. It's very difficult, in my opinion, to visualize these directly from the graphs. So this way it'll make things easier for us. So let's see. What does it look like? Ah, here we go. So here's the payoffs. Here's the stock. Here's the first option. Now remember, this first option has a strike of 50. So you can tell by looking at these payoffs. So we are having a zero payoff up to 50. After that, it goes up by 50 cents every time the stock price goes up by 50 cents. On this side of the fence, though, we're actually selling a call with a strike of 53. So we have all these zeros here. And once we get above the strike of 53, I'm suffering losses down here. And then in the far right column, all I've done is added these two together. And look what happens now. The payoff starts at 0, then it goes up for a while, and then it hits a peak of 3, and then it never changes again. Ah, that's interesting. Guess what this looks like? This is the payoff, remember. Oh, what do you know? How cool is that? All right, I think you'll agree that that's an interesting payoff profile. And again, don't forget though, this is the payoff. This does not include the premiums that we paid for these options. So you can see again, as if this stock stays between the two strike prices, then as the stock goes up, the payoff will go up as well. Once we get past 53, our payoff is capped at $3. On the bottom side, though, once the price gets down to 50, the payoff is basically limited to 0. It cannot be negative. All right, now it's time to add the profits and losses. I mean, plot the profit and loss. So let's look at this next chart and keep in mind the call option with the 50 strike has a $3 price and the second one is $2. So here, now look at these. I've subtracted $3 from the payoffs I had earlier for the first or 50 strike call. On this one, though, I've added $2 because I'm the seller. So what that means then is that, remember, I paid $3 for this call, but I collected $2 from this call. So the net cost of this position is $1. So I'm going to take my payoffs from up here and subtract $1 from each one to come up with my profits and losses. And now our losses are limited to $1 and our gains are limited to $2. So when you put all that together on this plot, you'll see, oh, that looks familiar. So again, down here you can see there's a maximum loss of $1 and there's a maximum profit of $2. So it's a bull spread. It's a fairly conservative bet that the stock price will go up. You're thinking it'll go up, but not so much you have to worry about the upside potential. Wow, interesting. Now, the purpose of a bull spread is to speculate that the price of a stock will rise in the future, but not by a considerable amount. The bull spread is cheaper than buying the low strike call option. All right, now, um, okay, so, all right, now what I'd like to do, well, first, it's 7:30, so we may as well take a break. I actually have more strategies written up somewhere. I may have over trimmed these notes a little bit that I'd like you to see. I will go find them during the break because I see that yeah, there's more that I would have liked you to see. I guess I was worried that we'd run out of time, so I will go find them and then we'll look at them when we get back from the break. Okay. So there's a few others that I'd like to add back to these notes because I see this is awfully interesting material, and I think you might enjoy these. All right, so we'll stop right here, and then I'll see what I can find. Okay.
Thank you, Professor.
All right. See you in a bit. All right. So yes, I did find some more notes where I'd put together some more of these wonderful strategies, because it looks like I kind of trimmed it down a bit too much compared to what I think we have plenty of time to get through some more of these. So I wanted you to basically see the opposite of a bull spread. So by the way, when we're done, I'm going to take this new document, which has more strategies in it. I guess I could send that to you as well, so you can have both sets and you can go through all of them on your own if we don't get to them all. But the corresponding, the equivalent or the opposite of this, I should say, is what we call a bear spread. And a bear spread is exactly the opposite of a bull spread. You think that the price of this asset is going down and you want to make money by betting on that happening. But you're doing it in such a way that there's a limit to how much you can make, but it's a cheaper position than simply buying, let's say, a put or whatever the case may be. This is a cheaper alternative, but it also causes you to sacrifice some of your upside potential. So anyway, so this one, just like with the bull spread, it can either be constructed of calls or puts. So we either call it a bull call spread or a bear put spread. We're about to construct a bear call spread. And so this time, all that's different is that we're taking the same two options from before, the 50 strike IBM that sells for $3 and the 53 strike IBM that sells for $2. And instead of buying this one and selling this one, we're going to do the opposite. So now we're buying let's see what happened here. No, I've got something went wrong. This is incorrect. We sell the first call and buy the second. Okay, so we're reversing the opposite, the bear spread, the bull spread rather. Okay, so instead of buying the first and selling the second, we're doing the opposite. So if you look at this chart of payouts, you'll see, yeah, because you can see that this one, we're clearly selling the call, and here we're clearly buying it. And so therefore, you can see that here, when the option's in the money, all these payouts are negative. And for the second option, the 53 strike call, when the option's in the money, we have a positive payoff. So the payoffs alone, you can see, range from 0 to minus $3, which doesn't look very promising, does it? It does not. So let's see what this thing looks like. Oh, well, what do you know? It's basically the upside down version of the bull spread. All right, let's go get that bull spread. In fact, maybe I can sneak them both onto the same slides. You can really see them better. Just about. So yeah, I mean, essentially you can think of one as the reverse of the other. Or you can think of it even more interestingly enough as the bear spread means you've sold the bull spread, meaning that you've reversed the two positions. Oh, I grabbed the wrong one. This is the profits and losses. Hold on. This one, that's what I wanted. So you can see them all together in one place. You can visualize more easily what the two of them look like. All right, so yes, one is simply the reverse of the other in the sense that you can think of it as one is flipped over upside down from the original bull spread. So the logic is exactly the same, except that now we're bearish on the stock. We think the price is likely to go down. And so in this range, of course, we will make money if that's true. Now, of course, here, now what's interesting about this position is since the bull spread cost us $1, the bear spread actually generates us $1 of revenues when we set it up, because we're buying the cheaper call and we're selling the more expensive ones. So we're actually making money from this position to start out with. And then on top of that, we have all these payoffs so that when we're done, the range of possibilities is from a maximum profit of $1 to a maximum loss of $2. So we basically shift up the bear spread by $1 because we collected $1, and this is the final result. How interesting is that? Okay, so flat top here, we're actually making money if the stock price is falling, and then down here we reach our maximum losses if the stock price stays above $53. Okay. Now, of course, you may say, well, why would we ever do this? Again, it's because we have a position, we have a view. We think that the price is likely to go down for the IBM stock, but not very far, certainly not below 50. If it does, we might be very upset with ourselves. Okay, now here's an interesting one, the butterfly spread. This one is very, you will see when we get to the graphs why this one is so interesting. It's more complicated because it requires us to use options with 3 different strike prices. So the basic logic is this. You're buying an option with a low strike. You're buying an option with a high strike. And look at this one. You're selling 2 options with an intermediate strike price, with the understanding that they all have the same maturity, underlying asset, and type, meaning they're all calls or else they're all puts. Well, so what we're going to do is introduce another call option in IBM. This time we'll assume that the strike is 47. It matures once again on September 1st, and it sells for $5. So we got all 3 of them this time. So I've summarized them on the following slide. Okay. So 2 of them we already have seen before. There's 3, and of course, in the real world, for any option, there's usually multiple strike prices to choose from. So again, our strategy is to do the following. We buy this one, we buy this one, and we sell 2 of these, okay? And which we're certainly allowed to do. If you can buy 1 option, you can buy 2 or 4 or 8. Same thing with selling. You can sell as many as you want. Now, it's going to be next to impossible to visualize what kind of payoff this represents. But when you see it, I think you'll be impressed. Okay. So there they are. I've got all 3 of them together in one nice little chart. So just remember, in this first case, the strike is 47. Here it's 50. And here it's 53. Except now that we own the first one and the third one, so you can see here we're out of the money up to 47. I'll abbreviate it OTM. Actually, no, sorry, it's only the first 2. 47 itself is at the money. This one is at the money, and the rest of these are, of course, in the money. Whereas on the far end over here, the strike is all the way up to 53. So here we're out of the money, at the money, and in the money. Now this one, because the strike is 50, out of the money, at the money. Now here, when we're in the money, we're losing. And not only that, but you'll notice here, when the stock price goes up by $1, we lose $2 instead of just 1. And that's because, of course, we sold 2 of them. So we're doubling our exposure to the stock with this position of 2 sold call options with a strike of 50. So this makes this very steep compared to the other 2, where the slope is either 1 or -1. Here, the slope is -2. Now, we're not going to list them all separately. Oh, and by the way, here's where all the payoffs have been added up. Now, because we bought the 2 options and sold the two in the middle, how much did this position cost us? Let's see, let me just add that here. We pay 47. Oh, sorry, 5. We're paying the call premium. We pay 5 plus 2 minus 2 times 3. So this whole position only costs us $1. We have all these options, and yet it's only costing us $1. So let's see what the payoff looks like. Oh, now that's interesting. Look at that thing. We haven't seen this before. That's our 50 strike. This is our 53 strike. This is our 47 strike. So what's happening here is that if the stock price stays between what we were calling X1 and X3, which is of course $47 and $53, we have a positive payoff. Otherwise, we have a zero payoff. Now, this is the interesting part. We're not actually betting on the direction of the stock, because if, let's say we start out with a stock price at 50, we can actually make money if the price goes up or down. So what exactly are we betting on here? Good question. Okay, so let's see what this is all about. In this case, we can make money if the option, a stock price rises or falls, but not outside the range from 47 to 53, of course. Okay, so we are betting that the price of the stock will remain stable okay, and we'll earn money or make money if this happens. Oh, okay. So in other words, we're not betting on the direction any longer. What are we betting on? We're betting against something called volatility. We are betting against volatility, which means that the stock price fluctuates significantly. Okay, so now, of course, as a reminder, a bull spread equals a bet on the price rising. A bear spread means a bet on the stock price falling. Here, we're not doing either one of those things. We're saying we do not think that the stock price will be volatile during the lifetime of the options. So this is something new. We haven't seen this before.
Professor, would this be the most conservative type of betting I could do? Let's say if I
No,
didn't want
not
to do both
necessarily. This is not extremely aggressive, but it's not the most conservative. I would say that the bear and the bull spreads are more conservative because here, well, maybe not. I mean, I would say, you know what, you know how we can find out? Let's go to our document and see what they have to say about this. It's here. I know they have it. Let's see what their opinion is of whether or not this is a conservative. Okay, now let's see if I can find it. No, I think I went too far here. I don't know if this is on that. There we go. Oh, this is it. This is what we just created. This is when we take into account, by the way, the price. We haven't actually gotten to that slide yet. Let me just go ahead a little bit here and show you. This is what it looks like when we take into account the cost of the option. Remember, it costs $1 to buy this option, these options. So we have 2 break-even points. And here the maximum loss is $1. Okay, so let's see what they think about this. It says here, whoops, market outlook is neutral around the strike. The risk is limited, the reward is limited. Volatility makes this position worse because that means that there's a chance that the stock price will move way extremely high or extremely low. That would be a problem. So we're betting against that happening. We're betting against volatility, where volatility itself, like I said, simply means the price fluctuates significantly over time. Okay, so this is a bet against volatility or in favor of stability of the stock price. So it seems here that they're saying that it's a relatively conservative position, which I guess I agree with them, because you can see there's a maximum gain and there's a maximum loss, and they're pretty close to each other. And this is, by the way, the version, like all spreads, this can be done with all calls or all puts. Now, what if we have the opposite outlook? By the way, here's the chart where I calculated this position. I put in all the option prices, but remember, the total cost of this position is $1. So really, all you have to do to convert the payoffs to the profits is subtract $1 from each payoff. Now, what if I have the opposite view? Suppose I think that the price will be very volatile in the next few months. What I can do is exactly the opposite of what I just did. In other words, I sell, let's say I have X1, X2. Sell, sell, and buy 2. And like before, this one earns $1 instead of costing me money. But what does it look like? Well, the thing is, because I'm selling the previous position, we've seen already enough examples to know that it will flip upside down. I don't have, unfortunately, a separate graph here, but I can draw it for you right now. And so what's going to happen is that you'll end up, actually, let me fix that a little. This is not the best graph. So it's just upside down. Here's 50. Here's 47. And here's 53. This is what we call a reverse butterfly spread. Now, if you notice here, we can only make money. Let's say the current stock price is 50. The price of the stock has to go. This would actually be 52 because, let's see, no, I'm not sure. I'd have to look it up, but we have these break-even points, but you can see in order for us to make money, we have to avoid staying near that current stock price. In other words, we do not want it to stay in this neighborhood. We want it to either go up or down as far as possible in order to make money. So here we have a maximum profit. Which isn't much. in this particular case, but it's a very inexpensive position on top of that. So basically here, this is a bet on volatility because we profit if the stock price either goes up a great deal or down. Okay, now this is something you don't normally get with other securities. Betting on volatility is something that's very hard to do unless you're dealing with options. Okay, so the reverse butterfly spread is a bet on volatility, i.e. it profits if the stock either rises by a significant amount or falls by a significant amount. So that's what you're hoping for. And you'll make money if you're right about this. So this is the unique feature of this reverse butterfly spread, and the other one too, for that matter, that for the first time, we have the ability to bet not on the direction of the stock, but on its volatility or lack of volatility. But you can see it was a very complicated position to set up. So with all that being said, now we're ready for the next category of strategies, which I mentioned before. These are known as combinations. A combination means there's at least one call and at least one put. So there's four basic possibilities here. Now there's many more, of course. And you'll see, here they mention them, they're very, very risky. In fact, if you look at this book when you get it at home, you'll see that this one falls into the category of volatility strategy. In fact, there's a lot of them. There's some really wacky ones. Look at this one. Can you imagine setting that one up? What are you betting on? Well, you want it to stay below this point or above this point, but not in between. Well, I guess that counts as a volatility position. There's so many of them. The sky's the limit when it comes to option strategies, as you can imagine. And this is another thing that accounts for their enduring popularity. So when you put together, in the first case, a straddle is a combination of a call and a put with the same strike, the same maturity, and the same underlying asset. If any of those are different, then you're creating something completely different. Okay, it's no longer a straddle. Those positions do exist, but they're not straddles. And what's the point? I'm glad you asked. So let's go back to the IBM stock. And let's say that besides the 50 strike, which is $3, we also have a put, which is a 50 strike, which is $2, and we buy them both. Okay, so here's the payoffs. And we own them both. There's no negatives. The strike is 50 in both cases. So the put is in the money here. The call is in the money down here. And the put is in the money up here. But if you notice the sum of the two payoffs, look at that. It's always positive. And it, of course, doesn't go below zero. So what you've got here is an enormous triangle. Ooh, there you go. Now look at those payoffs. Doesn't that look like a great position to be in? It looks like a great position to be in. I can't lose. Now, the only negative thing, of course, is that this is an expensive position because we had to buy both the call and the put. In this case, that'll set us back $5. And so when I take that into account, if you notice, the profits have all fallen by $5. So there's this range in here where we could still lose a fair amount of money, although, of course, never more than we started out with. And now look at this thing. So now it looks a little bit more frightening because let's say the stock price is currently at 50. I have to go all the way down to 45 or up to 55 to break even. Anything after that, I'm making money. So this is a direct bet on volatility. But unlike with a butterfly spread, there's no maximum profit. So remember, with the butterfly spread, once you get up to a certain point, it flattens out, and that's our maximum profit. Here, we don't have that. We can make as much money as, I mean, if the stock price goes up to 100, we could really clean up. So this is our straddle. So this is a popular way of betting on volatility in the markets. Like, for example, let's say tomorrow, this company is a biopharmaceutical company, and tomorrow they're about to announce whether or not their new drug works or not. Either the price is going to go up a lot or down a lot, depending on what the announcement is. So why bet on one or the other? Why not bet on both? We don't know which one will happen, but we don't care. If the price goes up because the drug was successful, we'll make money. If the price goes down because the drug was not successful, we'll make money. We don't care. The only thing that can go wrong is if tomorrow they postpone the announcement for another month, and then the price will just stay where it is, and then we'll end up losing money. So as long as it moves one way or the other, we're going to make money. And that's what we mean by bet on volatility.
How risky would this be considered, Professor?
I would say it's pretty risky because it's so expensive. Keep in mind that this position is only likely to be in place for maybe at most 3 months. And so that price has to really move by at least 10% of its current value just for us to make money. So I think we're starting to look at some very aggressive positions here. In fact, let's see if the book agrees with us. Well, it's kind of, I'm not sure how helpful that is. Limited risk, unlimited reward. Well, I'll tell you what. Let me show you a position that is terribly risky. What if we reverse this? What if we are of the opinion that the price will stay in a narrow range, just like with the butterfly spread, but this time we're setting it up by buying a call and a put. Now, that means that we're simply going to flip it over, and let's see what the consequences are. And I think you'll agree, this is pretty scary. Remember, we're betting against volatility here, or on stability. So we just flipped it upside down. So here's 50. Here's 55. And here's 45. But this time, unlike the butterfly spread, where we had maximum losses, what do you notice about this position? There's no limit to our potential losses. Okay, we're betting. Think of this as a bet against volatility. Or you can think of it as a bet for stability. But here, there's no maximum loss, although technically there is. On the downside, it can't go below 0, but for all practical purposes, there's no maximum loss. So it is much riskier than a butterfly spread. And so let's see if we can find that in our book of strategies. I'm waiting for them to give me a huge, like, this one is horribly risky. Oh, come on. There it is, short straddle. That's the one. Sometimes it's called short. I call it reverse. Sometimes it's called short. There it is. The risk is unlimited, whereas the risk is limited. And of course, it's what?
You said risk, it's the reward, yes.
Yes, the risk is unlimited. There's no maximum to how much we can lose, but the reward is limited to how much it can only go up so far. So this is a pretty awful position to be in. So you better be sure if you set up a short straddle. That's right. And here, of course, volatility hurts the position because that would move this price out here somewhere and you'd end up losing money. Ooh. So that's a very dangerous position to be in.
Why
Very,
would anybody do this position? Like, would they have to be sure of what's going to
yes.
happen in the market?
Yes. And also, the other thing to think about here is that when you set up this position, you're not paying for it. You're collecting the premiums from both options. So therefore, which were like, let's see, how much were they again? We paid $5. Okay. So in other words, we're collecting the $5. So it's like people are giving us money to take on this bet. But yes, you're right. Now, here's the thing though. You may combine these with other positions to create an even more elaborate strategy. So it may be that you're not setting this up just by itself. When you put this in combination with another strategy, it may turn out to be very safe. But like you'd have another call in here somewhere, or you write a put. In fact, if you look at these very complicated strategies in here, you'll see that some of these are basically the simple cases with another option added to them. So I wonder if we can find an example of that. Yeah, that would be nice. You can see how we can convert something like that into something much safer. Oh boy, some of these are really getting out of control. Well, there's our butterfly. But yes, sometimes what's happening is that we're not just doing this, we're also adding it to an existing portfolio of options so that the overall position may actually turn out to be relatively safe. Man, there's so many here. And I'm sure even here, we're just scratching the surface. But yes, you have to be sure, or else you would combine this with another position to create something that's not quite as risky. And but yes, the whole purpose of these strategies is really to make money, to gamble, to speculate. Although it's possible too that you own a security that would be harmed by volatility. And so what you're trying to do here is create a payoff structure that will help you out if something goes wrong with your position, and vice versa. But probably this is being used for speculation. But anyway, so there's our reverse straddle. Now, all of these positions in principle can be reversed by just selling what you normally would buy. Now, here's an interesting variation of the straddle. It's called a strangle. And you're still buying a call and a put, but the difference is that they have different strike prices. So the good thing about this is that it's a little bit cheaper. The bad thing is that it's harder to make money. So let's say now, instead of buying both 50 strike calls, 50 strike call and a 50 strike put, we buy a 50 strike call and a 50 strike put. Okay, the put has to be lower than the call, by the way. Otherwise, it's a completely different position. So let's see what the graph looks like. There's the tables. And here's the graph. Oh, now look at that. What happened? We lost that peak on the bottom. It now suddenly has a flat bottom. So what it's basically doing is it's extending the range of prices that are required for us to make money. But in exchange for that, it's cheaper than a straddle. Now, I don't know about you. You know what this reminds me of a flat bottom paper coffee filter. Isn't that what that looks like to you? You can imagine here's the coffee grounds. They're going to make the coffee right now. That's what it makes me think of. I don't know. It's kind of, the shape is the same, isn't it?
Yes.
But yes. So anyway, so once you take into account the cost, look at this thing. Look how far out you have to go to make money, up to 57 or down to 46. So it's a little bit cheaper, but it's even that much harder to make money. So it's sort of like a modified straddle. You're still betting on volatility, but you know, it's going to be hard to make money, but it's cheaper. And you can pick any two strikes you want. You can have it be as close as you want. So in other words, there's a lot of possibilities here. You could, for example, have something like this where it's almost the same as a straddle, and something like this where the strikes are very far apart, and you could have anything in between. It just depends on your view on how volatile the stock price is likely to be and how much money you're willing to pay for that position. So they're both straddles, but strangles rather, but they have very different shapes because of the strikes that I chose. All right, now there's two, and of course you can have a reverse strangle. You can just flip this upside down if you sell the call and the put. And of course, that just means you'll have an upside down. It'll be like a rowboat that's tipped over. Okay, let's see what that looks like. And again, you can see this one is really risky because look what can happen. Oh my God. Yeah, the potential for harm is very high here. This is the low strike. This is the high strike. Man, the possibilities are endless, aren't they? All right, now here's some more interesting variations of the straddle. A strip is basically a straddle, except that instead of buying a call and a put with the same strike, we buy one call and two puts. Again, with the same strike price on the same stock. So what are we trying to do here? What's going on? First thing we notice is that this makes the position that much more expensive because we bought three options instead of two. So what exactly are we expecting to happen? All right, well, the way to think about it is this. Let me just show you what the picture looks like. It's basically, I guess you can think of it as a big check mark. What's different here, though, is that here the slope is 1, and here the slope, instead of +1, it's negative 1, it's -2. So on the downside, each reduction in the stock price by $1 increases our profit or a payoff by $2 instead of just 1. Now, of course, this is a dreadfully expensive product. So when I show you the profit and loss diagram, you'll say, ooh, boy, we really have to move it to make a profit here. Now, let's think of the motivation of the trader who's doing this. The trader, and yeah, you can see, wow, there's a lot of movement required there to make money. But what's happening here is the trader expects volatility or high volatility, but thinks that the stock is more likely to fall than to rise. Okay, in other words, that's why we're putting 2 puts on, because we think it's more likely that it'll drop. I mean, we'll still make money either way, but we'll make more money if it falls. So in other words, we're pretty certain that not only is the price going to be volatile, but it's more likely to fall. So in that case with the drug company, a basic straddle would make money if the price goes up or down, if the drug either is successful or not successful. Here, we're basically placing our opinion that we expect one or the other to be true, but we think it's more likely that the drug will not be successful. And so therefore we buy 2 puts instead of just 1. All right, now there's just one more here we want to look at. And that is and of course there's always, whatever position we have, we can reverse it. We can flip this thing upside down and it would basically look like this. So this way, if we're wrong, if the price drops, we're going to lose $2 for every $1 that the stock price drops. So we don't really want that position, do we? Unless we're absolutely certain that this isn't going to happen. Now, if there's a position with 2 puts and a call, you can probably guess what's coming next. How about 2 calls and a put? Why not? And so instead of calling that a strip, we call it a strap. And again, some trader somewhere along the way made up these names. We do not know what they actually are for. There's clearly no connection, but it happens. Names get chosen and that's the end of it. Don't ask questions. That's what it's called, a strap. So we're buying the 2 calls and 1 put. And so the graph will be not like a perfect V like the straddle. It'll be twice as steep on one side, but instead of being twice as steep on the downside, it'll be twice as steep on the upside. Well, let's take a look at it. Okay, so we can skip over this and, oh yeah, look at that. So the slope here is -1. And the slope up here is 2. That means we're making $2 every time the stock price goes up $1, or we gain $1 when the stock price goes down $1. But remember, this is the put. This is the payoff profile. Obviously, we're going to pay a lot of money for this position. So we have a lot of gains to go through before we actually can start making money. The stock price really does have to move a great deal in order for this to happen. All right, so let's take a look at that. And oh yeah, look at that. Oh my God. It's like a $12 spread between these 2 points. Ooh. All right, but yes, we're making twice as much money in the upside. So again, getting back to the analogy of the stock on the drug company, we're saying that we really think that tomorrow they'll announce that the price will go, the drug is very successful or it's not successful. And either way, the price will move a great deal. But now we're saying that we think that it's more likely to go up than down. That's why we're putting so much money in the second call, to make sure that if we're right, we make a lot of money. Why, can you imagine how nerve-wracking this must be, trading options? You can actually do this. Anyone can buy options. You don't have to be a professional trader, but you have to realize that the brokers may say to you, listen, what kind of money do you have laying around? They want to make sure you can't gamble away all of your money. And they also want to make sure you have some basic understanding of these markets before they let you start trading. It's not like stocks. Anyone can buy stocks. But options, there could be restrictions on what you're allowed to do until you can prove that you either know what you're doing or until you have enough money so that you can't wipe yourself out. So, but yeah, these are very risky positions. And you have to be constantly paying attention to market conditions and have access to all kinds of real-time information and know how to interpret it. Now, if you don't like your position, by the way, there's nothing to stop you from selling it to somebody else. Okay, you don't have to just let it expire. You can always sell your position to another trader if you start to think that you've made a mistake. All right, so that's something that often gets done. Or if you want to change the basic position, you can actually add more options to it to make it either safer or more risky. In fact, if you, just as a side note, if you combine a bull and a bear spread, then you're actually locking in a specific rate of return, which you'll receive no matter what happens in the market. So yeah, they may have that in the diagram here. Sorry, in the book. Let's see what I've got here. There's something called a box spread. I don't know if they have that. Oh, they don't have that. Maybe we can get that off of Google. A box spread is an option strategy that combines buying a bull call with a matching bear, with a bear put. Okay, let's see if they have a graph of it. Oh boy, that looks complicated. Oh no, why don't they have a graph? Oh my God. Let's see if we can find one on the internet. Okay. So basically what they're saying, you recognize these right away. This bottom one, this is our bear spread. Wait, no, it isn't. What happened here? They've got them backwards. What happened there? This is the bull spread and this is the bear spread. But anyway, what they did get right here is that the combination of these two, you see this gray line, whatever that number is, that's the amount of money that we'll lock in by combining these two. So let's say that's $3. That means no matter what happens in the market, because of the way we've set these up, we're guaranteed to earn $3. Interesting. Here's another one. That's a little better because they've actually labeled them correctly. So here's the bull spread. Here's the bear spread. Wherever they cross, there will be a line cutting across here, which shows us that we're guaranteed to make this much money. Okay, this much money we're locking in by creating this box spread.
So there's like no loss here.
We can't lose. Now, having said that, though, it sounds like this is a sure way to make a bundle of money. Oh, here's a good one. Yeah, this one is drawn a little bit better. You can see that we're guaranteed to get a $50 payoff, actually a profit from this position. So you're probably saying to yourself, well, how can this be? Wouldn't there be arbitrage opportunities here? And the answer is no, because what will happen is the cost of setting this up will be so high that the return to this will be the same as just buying a treasury bond or something like that. So otherwise there would be arbitrage opportunities. Imagine if you could spend $5 on these positions and lock in a profit of 50. Well, everybody in the planet would be doing this. So it's a little bit deceiving. All you're really doing is locking in the risk-free rate of return. And so while it looks like a sure moneymaker, you could say the same thing about it buying a treasury bond too. You're guaranteed a certain rate of return and that's it. So anyway, but I mean, here's why this is relevant. Imagine if you had created a bull call spread and you changed your mind. Rather than selling the bull call spread, you could now add to that a bear put spread and thereby lock in a guaranteed return instead of taking a risk on your bull call spread. So you've created a new position from the existing one in such a way that all of your risk disappears. That would be another way to essentially unwind your position. So yeah, oh, we got all kinds of goodies here, don't we? Now, by the way, oh God, I almost forgot. We have this wonderful spreadsheet here I think the purpose of the spreadsheet was for you to fill it in for your assignment. I guess we don't want to mess with it. But what I've done for you here is I've set them up just like the slides, and your job is going to be to fill in the missing boxes. And then now, I hope you have some experience with Excel. It says in the instructions you do not have to draw any graphs, but you might want to think about it because it'll really help you visualize what you're doing. It's not that hard to create. Oh, here's one. All you have to do is select that last column, which contains the profits and losses, and ask for, if you say insert, if you ask for recommended charts, it'll show you a lot of possibilities, and usually the one you want is in here somewhere. And so that way, that's all you have to do. And then you can fiddle around with it, you can label it and all. But what you'll need to do in your assignment is basically fill in the missing boxes so that, where are we? Let's get that thing open real fast. Where are we? So here's what you have to do. It's a really short one. Fill in the boxes so you can show the payoff and profit and losses to the following: bull spread, bear spread, butterfly spread, straddle, covered. Oh, we didn't do the covered call and put. All right, let's just quickly get those done. Those are interesting too because they involve the underlying asset, which we have not seen before. A covered call means you own the stock and then you buy a call to go with it. What this does is it gives you money now, but it also puts a limit on how much you can possibly make from your position. So if we, going back to our old friend, the IBM stock, the strike is 50 on this option and it sells for $3. So what if we buy, oh, I just realized I'm completely wrong. We're not buying the call, we're selling it. Okay, so we own the stock, we're not buying the call, we're selling it. So the profits come from collecting the premium of the call. So we're collecting the call premium, but we're giving up a lot of the upside potential on this stock. So we're assuming here that the stock price equals the strike of the option, which is 50. And so what we have to do here is the payoff to the short call option is here. We combine that with the stock price. And so the payoff is right here. It's the sum of the stock price and the short call option. Now, keep in mind that we're assuming that the stock price was originally $50. So therefore, here I've lost $4 in my stock and I've made no money from my options. So I've got a payoff of negative $4. And then they all work the same way. And so this is the payoff profile. And you can see we've given up all the upside potential above $50, the strike price. But, okay, we put $3 in our pockets too. So therefore, this is what it looks like now. So if the price stays at 50 or above, we'll collect our $3. But once it starts falling, if the stock price falls, we'll end up losing money. And you can see we could go a long ways down. Now, I'm not really a big fan of this position. The one I really like is the next one. The protective put means that you own the stock and you buy a put. So the beauty of this is that it basically puts a floor underneath the value of your position, meaning you're putting a limit on your losses. And in exchange for that, you pay for the put. So in effect, you're buying an insurance policy on your stock. It's exactly the same thing. You pay a premium, and if the stock price falls, you'll get a payoff from your put, which exactly offsets it. So the same thing. We've got IBM stock. The strike is 50 for this put that we're buying. It sells for $2. And again, let's assume that the stock price was originally 50. So look what happens here. The payoff starts at 0 and it goes up by $1 for every $1 increase in the stock. The cost of the position is $2. And look at that. Now, interestingly enough, the payoff to the protective put, and we'll see why this is later on, equals the payoff to a long call or a call option that we own. How do you like that? It looks just like it is the call payoff. The payoff is the same. The stock and the put are giving us the same payoff as a call option. Nice. Very nice. So when we take into account the $2 we paid for this thing, you can see that all of a sudden, no matter what happens in the stock market, we can never lose more than $2, the price of the put. So we're buying protection on our stock. Now, the only drawback, of course, is that if the price of the stock never falls below 50, we'll end up losing $2 no matter what happens. But still, that's a small price to pay, I think, in exchange for having this protection from the stock price going down. So in other words, if you have a stock where you're a little bit worried about it, rather than selling it, you could think about buying a put. And that way, no matter what happens in the market, the price, the profit will never go below this negative $2. So here I've got these wonderful little summary tables in case you need them, and to help us understand what we've just done here. It's hard to memorize this stuff, of course, but this way you've got a nice little reference chart so you can see exactly what we're doing. All right, now these are the extra notes. I'll add these to my what I send you later on, including this book, which I'm sure you're dying to have after seeing all these wonderful diagrams. And you'll see some of these are really kind of shocking, like this one. You sell a call and you buy 2 calls at a higher strike, and look what ends up happening. So it's basically a bear spread where you've bought 2 instead of 1 call at the higher strike. Okay, what about this one? Look at that. It's you sell a put, and here you're making a lot of money if the price goes down a lot. So you're selling a put and buying 2 more at even a lower strike. So yeah, the possibilities are almost endless here. It's really amazing stuff. So anyway, I guess we're pretty much done here, unless there's something that I forgot about. I don't think so. So, all right, well, I hope that was interesting, because I think it's very interesting, all those amazing strategies. What is coming up? What could possibly top that? Oh my God, we're going to get ourselves involved with figuring out how to actually price these options. Yeah, where do those premiums come from? Now, this is going to get a little bit more serious, but we can do all of these problems in Excel, so it won't be as bad as it looks. Okay, don't worry, don't panic when you see them. All of this stuff can be done directly in Excel. All right, so all right, I guess it's time to go, and I'll see you all next week.
Thank you.
Thank you,
Okay.
Professor.
All right, bye. See you later.
Bye.
Thank you. Have a nice
Bye.
one.
Good night.